Now we're going to shift a little bit more into Europe and Asia as we start to look at some of the impacts that we've seen from the slowdowns, just because we want to be mindful of what's happened in Europe, because if we remember back in the beginning of this year, what happened in Italy reflected really what was going to happen in the U.S. and what can we expect, and are there ways that we can learn from it to kind of mitigate some of these issues. And then next week, we're going to go through in a bit more detail some of the geopolitical side of things as we start to look at policies, as we've had issues with Turkey, things with Iran continue to heat up. But again, those are things that we'll talk about next week. So here, when we look at German foreign trade, this is something to kind of hone in on. And again, please like, share, subscribe. Your support is always appreciated, just because it's very important for us to continue to maintain this data being free for you. So as we look at the German foreign trade, imports obviously started to slow down. Most of these were coming in below expectations. German imports were down about 0.1%, again, about 10 basis points. Exports were up about 2.3%. The exports was actually above estimates. It was, which is a positive to see, but the imports leave us concerned just because things were starting to slow down. We were starting to get lockdowns. We were starting to get concerns in terms of with their trade partners. So it's something that as we talked about some of those predictive natures of some of those import sides. And then the trade balance obviously moved up just because we had an increase in exports, a decrease in imports, helping that overall component. But again, we need to understand what is happening with the infrastructure side. So the industrial production side. So then when we look at the expectations of economic growth, and now looking at the Eurozone, you can see it's taken a marked shift down. Obviously, it's driven based on what's happening with COVID and the lockdowns. There was a lot of expectations of strong growth. We kept saying that this was a lot of exuberance that didn't make a whole lot of sense, and this is now getting priced back into the market. We still think it's too high just because the lockdowns will most likely get extended, as we've seen over time. But again, it's just going to be moving closer to that zero. We don't think we go too far below zero, just based on some of the benefits that we've seen on the manufacturing side versus services. But this is going to be something to watch as we head through the remainder of the year. And industrial production data, again, this is for the September period. And again, September into October into November, you're seeing the trends in terms of what we're seeing, and we're trying to be very clear in terms of things were already slowing down as we look at month over month. Actual versus survey. Prior being seeing revisions down. We've seen France see a decline. The expectation was for a decline of 5.5%. It was actually 6%. Month over month was a little bit better, but then at the same time, the year over year was worse than expectations, which we'll show in a different chart next. And then obviously on the Italian side, that continued to surprise to the downside, which when we start to look at some of the pain overall, we have to consider what is the expectations as we go forward. Finland came in a little bit better, but the lockdowns are going to impact trade, and impacting trade is going to impact those ancillary components. And just when we look at some of the dynamics within the countries, there's a lot of concern as we go forward. Like when we look at the French economic activity slips below that normal, below normal in second lockdown. Do we get to April? No. And we're going to continue to say that we will not get down to those levels. We understand the virus more. We understand things about the way people are going to consume. You don't have the same type of buy-in. You have some leniency in terms of where the mobilities are stopping. And again, this is going to limit the overall impacts. The impacts will get worse through November. It's just we're not going to 30%. We're going to go something closer to, let's call it anywhere between 18 and 22%. And when we look at overall the fiscal measures in terms of kind of cushioning this crisis, the share of employees in lockdown sectors, obviously Spain, Italy remain the biggest problem, especially when we look at the unemployment rate, share of workers. The issue that we continue to see is the struggles within Europe, but how it relates to Turkey. So Turkey obviously completely fired their central bank governor, the minister of finance. There was some hope of saving grace. The Turkish lira is strengthening again. The question is now, is this kind of a flash in the pan where there's expectations of a rate increase, again, trying to get the currency under control, but there's also some shifts in time. And when we look at, again, coming to Libya, where people are like, well, why, Libya has had civil wars, they're going to continue to have civil wars. The proxy influence is going away. And the reason why I say the proxy influence is going away is because people are losing money at the Russian level, the Turkish level. We've seen now Armenia has signed a declaration. They've admitted defeat in the areas in which have been lost. So Armenia and Azerbaijan have some sort of peace agreement where Russia will maintain a safety or security unit within the country of protecting the borders. They will allow Armenia will allow a road to be built connecting different Azerbaijan locations that will be protected and secured by Russia. And again, Turkey will probably have their hand in also securing all the different sides because Turkey is more Azerbaijan, again, Armenia, Russian. And it's just, we're not seeing the appetite for proxy wars. We're not seeing the appetite because when we look at the Turkish lira, when we look at the Russian ruble, there's rumors now that Putin might have to step down due to health issues starting next year. Novak has now been named deputy prime minister. Again, these are things that we have to watch when we're considering, which is a long way of saying Libya is not turning off anytime soon. And again, we're going to go into that more detail in tomorrow in the IA show. So when we look at some of the key areas, we need to look at also German expectation of economic growth, where the survey was 44.3, actual 39. Again, all of this is going to be shifting lower. Germany won't see the same type of impact. Again, we're not going to the lows that we saw in 2020. And again, as I should have said in the previous chart, it is important to look at how these charts looked in 2019. Again, there was an issue in 2019. There were issues in 2018. There were problems overall with economic growth, and they haven't gone away. They've only been papered over with stimulus from either the ECB or the government, and those are things that won't last over time, which is why we're going to continue to see pain to the downside, which again is showing up in the German manufacturing order and production, where we have orders year over year down 1.9%, month over month down 7.3%. Again, they got better month over month, but it's in terms of the declines, they're getting there. It's just the pace of getting better slowing. And again, now we're with the new headwinds of lockdowns and trade partners that they've seen, as we showed in the very first segment, in terms of those leading indicators, high frequency data points in terms of demand. It's just going to be a major headwind as we go through the remainder of the year. And again, looking at the Eurozone productivity PMI, again, real labor productivity is down just because of obviously issues. And then productivity PMI, again, is shifting lower, getting closer to that 50 number. And as we talked about over the in the segment 2, when we started looking at global PMIs, I should say segment 3, is global PMIs, what the issues are. These continue to be an overarching problem as we go forward. And as we spoke with the U.S., bank lending standards continue to be a problem. So for bottom two panels here, you can see the shift higher, especially in Spain, Italy. Germany's gotten a little bit better, but again, the total bank lending is heading in the wrong direction in terms of just the percentages as those standards get tighter, which is only continuing as we talked about a couple months ago, especially looking at Europe. Again, these are things that are just going to weigh on total lending as we head through the remainder of the year. And then what kind of support can we get in 2021 to try to get some of that stimulus, as we've talked about with what the ECB is doing, what the governments are doing, and how does that interact with the remainder of the year. Now, when we look at Japan, so this is one to watch because Japan, so South Korea had a surprise to the upside of unemployment. Unemployment has been fairly lumpy, But when we look at Japan, here you can see the expectations have actually gotten better. Survey was for 49.8, actual 49.1, still contractionary, but again, getting better over time to those levels. Again, when you look at 2019, you saw the slowdown in 2019. This was also driven because remember there were tax increases at the end of the year, so this is also going to reflect that. But you can see that it's just things haven't been going all that well within Japan for an extended period of time, even though they've had about 30 years of stimulus, which, welcome to stagnation and stagflation and the issues that we're going to face over time. But again, these are some benefits, which is, again, providing some backdrops. And if we think about the way Japan, South Korea, Taiwan really went after to stop the spread, stop the flow of COVID, you can see that it resulted in less damage overall. So these are things to consider as we look at ways to mitigate our own economy and to try to protect it from a resurgence, and how do we kind of tackle that resurgence to not have the same type of economic impacts we saw at the end of Q1 and Q2, and try to kind of bridge some of these gaps into a challenging Q4 and then what we believe is going to be a challenging 2021. So thanks again for watching. Tomorrow you can expect the EIA show. So we're going to have our EIA show come out. And then obviously we're going to have our favorite, the primary vision Frac Spread Count. So we'll have some shows. We're going to throw some policy in there. We're going to throw some things that we're starting to see. And then we're going to try to stay up on some of these issues that as they arise. And then next week, we're going to do a bigger one on geopolitics and what is happening, just because we've had, as we've talked about, Iran, Turkey, Azerbaijan, and then what is going to happen and what we think is going to happen as we look at China and beyond. So thanks again for watching. I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.